Hello, hello all. Very good morning to all and happy Friday. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Happy Friday and very good morning. Today will be the 30th of August 2024. So before we jump straight into our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so right now, before we jump straight into the intraday technical outlook for today on the major cross asset classes, let's have a quick recap what has taken shape yesterday in the performance of these broad-based cross asset classes, as well as related news flow and economic data releases. So yesterday in my daily dose, I do cover that NVIDIA, even though it has a rather lackluster earnings results and it has a negative feedback loop on the Nasdaq 100 and the S&P 500, but it did not actually created a dramatic, significant negative feedback loop in the US stock market, i.e. also in the global stock market as well, because of various reasons. One of the reasons we share with you all is due to the bull steepening of the US Treasury yield curve, which I shared with you all yesterday in the daily dose, which I don't want to touch because I covered that in much ground in detail. And with this bull steepening of the US Treasury yield curve in place, potentially we should start to see the outperformance of the prior laggards. That means, i.e., value-oriented related stocks like US financials, US industrials, and some of the healthcare stocks as well, which are heavily weighted in the Dow Jones Industrial Average. That means potentially in the next couple of weeks, provided that other key US economic data such as ISM Services PMI, ISM Services ISM Services PMI and ISM Manufacturing PMI. Pardon me, let me repeat. ISM Services and Manufacturing PMI data doesn't show an increased odds of US economy slipping into the recession. From a multi-week to a multi-month perspective, potentially we should start to see the prior laggard, the Dow Jones Industrial Average and the Russell 2000 starting to outperform the heavily weighted technology mega cap indices like the Nasdaq 100 and the S&P 500. And yesterday's so-called performance, intraday performance on the major US stock indices has clearly been taking shape already on the outperformance of this laggard. So yesterday, the Dow Jones Industrial Average added 0.6% and managed to scale fresh all-time high at 41,335 on the Dow Jones Industrial Average, followed by the Russell 2000 small cap added 0.7%, whilst the S&P and the Nasdaq 100 closed almost unchanged yesterday. So what we start to see now is the rotation into the so-called lagging sector or the lagging indices in the US stock market space. That means, i.e., we now start to see a rotation play. So what do I mean by this rotation play? If you were to look at the heat map of the S&P 500, okay, very quickly. Okay, so this is the heat map of the S&P 500. Yeah, so why the S&P 500 closed almost unchanged yesterday, which was due to the fall of negative 6% on NVIDIA, and as well as spreading a bit of losses towards Google as well, negative 0.7%. But overall, if you look at the entire carpet or the map of the S&P 500, there are actually more greens than red. The only aspect over here is that because of the heavily weighted towards NVIDIA, that causes S&P 500 to underperform. So if we dive deeper into the sectorial performance, that means we break down into the 11 sector. So S&P 500 is being made up by 11 sector. That means ranging, these are the 11 sectors. So if we go to groups over here, And let me expand my screen so that you guys could see bigger. Okay, so this is the one-day performance yesterday. S&P 500 is being broken down into 11 sector: energy, materials, financial, industrial, utilities, consumer cyclical, that means that's consumer discretionary, healthcare, real estate, consumer defensive will be consumer staples, info technology, and communication services. So the info technology and communication services, these are where the mega cap technology stocks are inside residing in this. So what we could see over here is that yesterday, those prior laggards that has been lagging behind since 1.5 years ago, or even during from the pandemic until now, has been outperforming yesterday, where the energy rose by almost 1%, followed by basic materials and, like I mentioned earlier on, financials, which other banks both added gains of respectively at 0.8% and 0.7%. So what we could see over here is the rotation play starts to play out. That means assisted by the bull steepening of the US Treasury yield curve. So for those who has joined, what is this bull steepening of the US Treasury yield curve? In a nutshell, it's actually supporting lagging sector or lagging stocks within the US stock market to actually now outperform against the heavily mega cap technology weighted stocks. That means going forward, potentially Nasdaq 100, S&P 500 will take a backseat, where Dow Jones Industrial Average and the Russell 2000 will now take a front seat to actually take the leading role in shaping this potential higher high scenario that we're going to see in the major US stock market phase. More details I already shared yesterday. So for those guys who actually want to have a recap, can take a look at our OANDA Asia Pacific YouTube video. Search for yesterday video dated on the 29th of August. So I covered that in the intermarket segment. And all the news I shared with you all yesterday is more pertaining to the FX market, where we start to see a rather we call it lackluster inflationary scenario playing out in the Eurozone. So yesterday we do have Germany, which is one of the major anchor economy in the Eurozone, reporting its preliminary August inflation condition, where its inflation rate actually slipped down below expectation to way below 2%. So last month was at 2.3% in July, but it slipped down to 1.9%, below 2%, and below 2.1% that was being expected by market consensus. So what it seems over here is that it seems to us that the Eurozone may be at risk of slipping into a deflationary scenario again, which i.e. the Eurozone central bankers, ECB, may increase the odds of having another round of aggressive interest rate cuts in situation to prevent any further spiral of deflationary scenario spilling over to the rest of the Eurozone or within Eurozone, given that Germany is one of the key anchor economy in Eurozone. So that actually causes the euro dollar to lose a bit of strength. So stay in mind, the euro dollar has been firm since the start of this week, holding above the 111 figure support level. So the 111 figure support level was taken out yesterday due to this rather lackluster, below the expected inflationary condition in Germany, and that causes the euro dollar, if you were to actually immediately just with the 5-day performance of the US dollar against the rest of the major currency, where we start to see the US dollar outperforming the euro dollar from a very short-term perspective yesterday. And what we could see overall, the US dollar is still kind of lackluster against the Chinese yuan, against the Kiwi, against the CAD, against the Aussie, and against the Swiss franc. So overall, what we could see right now, given yesterday's lackluster inflationary condition reading from Germany, being anchor key economy in the Eurozone, causes a spike of the US dollar against the euro dollar, and that actually causes a kind of a mixed bag scenario right now overall in short term, at least in the FX market space, as market participants awaits for today's key economic data pertaining to the US PCE inflation data in July. They're going to be out later evening time, Singapore time later today. Later I'll be touch on more about that. All right, and also another data I want to share with you all is more pertaining to Japan in the FX market space will be the yen. So what we could see over here is that the Tokyo Core CPI data, that's only including fresh food, actually continue to rose pretty much robust above the 2% BOJ target. So it rose above expectation. So market is expecting 2.2%. It rose 2 basis point more at 2.4% and also surpassed 2.2% that was printed in the month of July. So if you look at the trend on the Tokyo Core CPI data, so why do we need to have take a look at Tokyo Core CPI data? Because Tokyo area region is actually a leading economic inflationary indicator in Japan. So 2 weeks from now, Japan will release the nationwide one, but the Tokyo will release first because it's considered as a forerunner to give us a sneak peek of the latest inflationary condition in Japan. So I could see over here since May reading of 1.9%, it has been steadily increasing upwards to 2.4% as we printed earlier, as we mentioned earlier. So i.e. what we could see over here is that there is right now lower risk of Japan slipping back into a deflationary mode scenario again, and very likely BOJ will continue its gradual normalization policy in terms of removing QE in Japan that has been in there for close to about 10 over years, and slowly increase the policy overnight interest rate, because so far they right now last meeting in August they increased by 15 basis point, and now market participants are actually expecting potentially another round of increase before 2024 ends. So that should actually see some form of further yen strength against the Japanese against the dollar, where potentially yesterday's dollar yen rebound also managed to be kept below its 20-day moving average and the 145.45 short-term pivotal resistance that we highlighted yesterday in our short-term technical outlook as well. And if you were to remove this one, excluding energy, that means the core CPI rate for Tokyo, you also managed to inch up higher from 1.5% that was printed in July, and in August it inched up by 1 basis point higher to 1.6%. So if you look at the trend on the core Tokyo CPI condition, that means that's excluding fresh food energy, it slowly starts to temper upwards as well. All right, slowly. All right, some seems to be forming a base over here. All right, so net overall, what we could see over here is that potentially giving more reasons for Bank of Japan to normalize their interest rate policy, and also on top of that, this also starts to see the US Federal Reserve cutting interest rate as well, preventing the global economy from slipping into the recession, and also that could actually allows Bank of Japan to be much more aggressive in normalizing its interest rate more towards increasing rather than decreasing at this point in time. Now, with that actually sum up the so-called key economic data and events that I'll share with you all and its impact on the respective broad-based cross asset classes. So now with that, let us now take into consideration of the intermarket dynamics that is playing out right now. So if you look at the interdynamic situation, what we could see over here is that this is the yield spread between the US 10-year Treasury yield and the 10-year Japanese JGB yield. So this yield spread movement potentially has a medium term to long term impact of the dollar yen rate. So if you recall that the dollar yen has started to slip down since end of June, early July this year. On top of that, also the yen carry trade unwinding, it has been also been reinforced by the yield premium shrinkage of the US Treasury against the JGB yield, against the JGB. So what you could see over here is that the more sensitive one that is related to Federal Reserve policy is the 2-year Treasury yield minus the 2-year JGB yield spread. So what we could see over here is that the 2-year JGB, the 2-year Treasury yield spread against the JGB, the Treasury yield premium on the 2-year has slowly been shrinking since 4% that we see in end of July. Now it's managed to shrink down to 3.51%. It seems to us that it's inching downwards. No signs of a bullish reversal, potentially hitting the next support at 2.9% next. So if this scenario were to play out, that means i.e. what it means over here is that market participants right now is kind of assigning a higher probability that the US Federal Reserve were to actually more confidently and more obviously kickstarting their interest rate cut cycle, where the Bank of Japan will now slowly be very much nimble to slowly adjust their decades-long of ultra loose monetary policy back to normalcy. That means slow removal of QE, and as well as a very gentle path of interest rate hike cycle in Japan. And that IE should potentially see the 2-year Treasury yield minus of the 2-year JGB yield, that means it's the yield spread, slowly inching downwards towards the 2.9% support level next. That potentially could also be seeing further dollar weakness against the Japanese yen. The one that is more related to economic growth and inflationary growth will be the 10-year US Treasury yield. So what we could see over here is that the 10-year US Treasury yield spread over the 10-year JGB yield, that means the spread between the 10-year US Treasury yield and the 10-year JGB yield is continue to hover at a key major support at 2.9%. But if you look at the last few days, price action continues to trade in a series of lower high. That means also indicating that the yield premium on the 10-year Treasury yield note over the JGB has continued to shrink as well. So market participants will be very closely watching the US PCE inflation data. So like I mentioned earlier over here, the 10-year uh, sovereign bond yield, regardless of which country it is more as a proxy of economic growth and inflationary rate growth. All right. So if the US PCE inflation data continue to inch downwards, then what we could see over here is that we could see a revisit of that 2.9% key major support of this yield spread, and a breakdown below it potentially exposes 2.4% next. So overall, what we could see here is that the 10-year Treasury yield spread between the US Treasury note and the 10-year JGB also supports a further potential weakening of the dollar against the Japanese yen. All right. So another intermarket dynamics over here is more pertaining to the China stock market and its proxy, which is the Hang Seng indices. So we know over here is that this is the offshore Chinese yuan, that means the dollar against the offshore yuan, the CNH, that is much more easily tradable outside of China, continues to inch downwards, and yesterday it broke down a major support at 710.40. So given this bearish breakdown of the 710.40, assisted by also the much more evidence and much more we call it guidance coming out from the US Federal Reserve, stating that they are about to embark a interest rate cut cycle that could actually elevate the situation in China, allowing the China Central Bank to actually kickstart much more aggressive monetary policy potentially to address this ongoing internal demand weakness in China that could actually spill out to a persistent deflationary scenario due to a very weak property situation in China that is the most of the wealth impact on China comes from the property market. So given that the dollar is now steadily weakening against the Chinese yuan, it reduces the risk of capital outflow out from China and from Hong Kong, which is its proxy, and that could also potentially see a positive feedback loop, at least in the short term, into the China stock market and as well as the Hang Seng Index, in view that potentially the China central bank right now has much more leeway to engineer a much more aggressive monetary policy without the risk of further capital outflow from China, given the fact that the dollar now is weakening steadily against the CNH due to much more, we call it a firmer policy dovish guidance out from the US Federal Reserve. So what we could see over here is that by plotting in the CNH exchange rate against the dollar with the performance of the related China stock market. Let me share with you another chart, which is over here. All right. So at the top of this chart over here is the daily chart. Is the dollar CNH inverted? That means I inverted the rate. That means what it means that over here is being quoted as US dollar per CNH. That means one offshore Chinese yuan equals to how many USD. So what we could see over here is that at this since 18th of July this year, that means somewhere around middle of July. Okay, let me change it in a different color. Yeah, over here. okay, late July, end of July, the CNH has continues to steadily appreciate against the dollar, and this appreciation of this CNH against the dollar managed to trigger a positive feedback loop into the Hang Seng China Enterprise Index. So that is actually the H shares listed in Hong Kong Stock Exchange. That means, i.e., China stock listed in Hong Kong. Put it very simply. Okay, then you have the Hang Seng Index, which is has much more other Hong Kong property stocks as well. Okay, like Chung Kong, Hutchison, all this with the likes of Tencent as well, and some of the China H shares also stage this similar positive, we call it pull increase. Whereas the mainland China CSI 300 index continues to trade in a sideways range, but it's not inching much lower to break below the low that was printed in February this year. So it's more of a sideways formation. So what we could see over here is that, like I explained earlier, the intermarket dynamics or the economic rationale of why a potential stronger Chinese yuan against the dollar could potentially help to elevate the weak internal demand situation in Chinese economy. That could actually has a potential feedback loop, at least in the short term, within the Hang Seng indices. All right, from a short to medium term perspective, pardon me. All right, so now these are the intermarket dynamics that I want to share with you all for today. So with that, now let us straight away jump straight into the intraday technical outlook on the various broad-based cross-asset classes. So with that, let me expand my screen first so that you guys could have a better look at the key levels. So with that, let us start with the FX market over here. Okay, let me pull up the chart of the FX market. All right, where is it? Okay, starting with the euro dollar. So you could see over here is that the euro dollar yesterday it broke down below the 110 level. As you can see my cursor over here. So that was actually a support level that has in place since last Wednesday, a minor support level. So it broke down yesterday due to the weaker than expected Germany preliminary inflation rate data for the month of August. So with that, it seems to us that it's now coming very close to the 20-day moving average. So since it's already in Friday, so potentially it could trade in a sideways range configuration, holding above the 20-day moving average support, being supporting at 110.50 level. And also what we could see over here is that the hourly RSI has also started to shape a bullish divergence as well, because being Friday over here, potentially it could start to shape in more of a sideways range with an upper limit at 111.40. Unless during the US session it could break above 111.40, potentially being reinforced by a much more weaker than expected US PCE inflation data. So that could actually impact the euro dollar, and with that, then we could actually start to see a much more forceful return of that bullish impulsive move wave behavior on the euro dollar to retest last Friday swing high at 1.12 figure level. All right, so for now stay neutral, given that because it's Friday, but it's still holding now another key short-term support, which is the 20-day moving average at 110.50. So neutral between 110.50 and 111.40 for now on the euro dollar. And given this mixed bag of given this weakness on the euro dollar yesterday, it also has a spillover impact on the sterling dollar as well, where it actually broke below yesterday minor pivotal support at 131.70, 131.80, and now attempt to actually trade back above this level. So given that it's Friday as well, so I will actually turn neutral on the sterling dollar for today. So neutral between 132.30 and 131.30 figure level, 131.30 on the sterling dollar. Okay, so now moving on, next will be the Asia Pacific currency against the dollar, starting with the Australia dollar. So the Australia dollar continues to trade within a rather healthy short-term bullish ascending channel dynamic, as being depicted by the low of 6th of August that I drew over here. All right, and right now it's also attempting to shape another higher low. Okay, this low is higher than this low within this at very close to the lower limit of this minor ascending channel And what we could see over here is that the hourly RSI continues to display a series of higher low as well. And now it's just attempting to actually inch up above the 50 level mark and has yet to hit the overbought region yet. So net overall, it seems to us that the short-term momentum, bullish momentum still remains intact on the Aussie dollar. So with that, we will actually have a slightly tightened key short-term pivotal support level rather than using this first support level over here, which is a bit tighter. So that is today's Asia session low, which is very close to the lower limit of that minor ascending channel support as well at 0.6788. So we will use a slightly tightened one from yesterday, up slightly to 67.65, which was yesterday's minor swing low. So as long as 67.65 key short-term pivotal support that we have for today on the Aussie dollar holds, we will still maintain this intraday bullish bias on the Aussie dollar. Next resistance to look out for will be 68.50 in the short term. All right, that's good for today since it's a Friday. And if we start to see price action starts to break down below 67.65, then this intraday bullish bias will be invalidated to kickstart a minor corrective decline scenario to expose the next near-term support level at 67 figure level next, and a breakdown below it exposes 66.40, which also confluence with the rising 50-day and the 20-day moving average as depicted by the dark blue line and the red line over here. These are the two moving average that conversing at a similar graphical support level at 66.40. So that's for the Aussie dollar. So now with that, let us now focus on the dollar yen. So dollar yen, despite yesterday's we call it push up, it managed to actually clear above the 145.45 short-term pivotal resistance that we highlighted, also the 20-day moving average. So with that, this is indeed a key pivotal resistance to hold to maintain that intraday bearish bias on the dollar yen. So first support level to watch, no change, it will be at 143.45. So this level has been holding it since last Monday for the bears, preventing the bears from breaking down. So first support level will be indeed 143.45, unless we have a clear breakdown below it. If our hourly close at 143.45, then potentially we could start to see a much more deceleration movement on the dollar yen to at least retest the 5th of August swing low area at 14160/40 next. Only if we start to see a push up with an hourly close above 145.45, then this bearish bias will be invalidated to kickstart a kind of a mean reversion rebound to expose the next near-term resistance level at 146.50, followed by 147.50, and also potentially 149.30 next, which is the minor swing high of 15th of August and 16th of August. So very likely this movement of the movement that will detect dollar yen in today will be the up and coming US PCE inflation data. All right, so now that's actually sum up the FX market short-term intraday technical outlook. Now let us now focus our attention to the major stock indices, starting with the Asia Pacific one, which is the Hang Seng Index. So the Hang Seng Index continues to push up as expected, due to also supported by this rather weak dollar against the Chinese yuan. That means, i.e., the Chinese yuan appreciation against the dollar, reducing the risk of capital outflow from China, supporting a positive spillover impact on its proxy, which is the Hang Seng Index for the Hong Kong 33. So right now it's already hit our first support, our resistance level that we highlighted yesterday, 18,060, 18,070/18,160 level. So with that, the RSI now is already hitting the overbought level as well. So potentially, what we could see now, it could start to actually, not even the RSI, if you put up the stochastic. Okay, so usually I'll just do the RSI. So if you see the stochastic as well, it also now at the very extreme overbought level. So what we could see at this moment, at this juncture, there could be some signs of at least a minor pullback to the first support level that I highlighted at 17,860. So as long as this 17,745, which is our short-term pivotal support level that we have slightly below the first support 17,860. So as long as this pullback didn't surpass below 17,745, we will still maintain that short-term intraday bullish bias on the Hong Kong 33, with the next near-term resistance coming in at 18,350 level. So which is also the minor swing high of 12th of July, and also conversing with the upper limit of this minor ascending channel that I drew from the low of 5th of August. But however, if we start to see a price breakdown with the hourly close below 17,745 short-term pivotal support level, that would invalidate invalidate today's intraday bullish bias to actually see a choppy round of corrective decline scenario. In first step, to retest the 50-day moving average, acting as confluencing at this next support, my next near-term support zone of 17,540 slash 17,430. All right, a break below 7,430 exposes the 20-day and the 200-day moving average, confluencing at the next near-term graphical support zone of 17,270 slash 17,185. Now, moving that will be the other Asia Pacific index, will be the Japan 225 or the Nikkei 225. Still recall that yesterday we flipped to a bullish bias. Why? Because price action doesn't seem to be able to break below the 200-day moving average after trading in a very tight sideways range. So potentially it could be a kind of a Bollinger Band bullish breakout scenario. So with that, we will actually use the 30, still maintain, I do not put it so tight because we could use this as a first support level. That was yesterday's low at 37,920, but we still maintain at 37,480 as my short-term pivotal support level to maintain this intraday bullish bias on the Japan 225s. And right now it's actually about to break out above the 50-day moving average, which is our first resistance that we highlighted yesterday, 38,580. Next near-term resistance level to watch on the intraday basis, 39,270, followed by 40,055, which is the minor swing high or the minor congestion area of 19th of July at area over here. Only an hourly close, that means the price action came down and broke below the 200-day moving average, which is also the 37,480 short-term pivotal support level. That would invalidate today's intraday bullish bias to kickstart a minor corrective decline scenario to retrace certain portion of this minor uptrend phase from the high of 5th of August all the way up to 30th of August high, today's session high, yesterday US session high over here, to expose the 20-day moving average, which is also confluencing with the next near-term graphical support zone at 36,885 slash 36,630. Okay, so that's for the Japan 225. Moving on will be the German 30, which is one of the European benchmark stock indices. So the the German 30 continues to actually hit our first resistance level that we highlighted yesterday, 18,935 slash 19,025, which is the upper limit before shipping that pullback during the US session. So what we have over here is that for today, I will have a slightly tightened key short-term pivotal support level, which is Wednesday minor swing low area. This congestion area here will be my tightened key short-term pivotal support. So let me copy this. It's over here. Okay, so this level will be at 18,730, pardon me, 18,730. Then this will be my next support level to watch. Okay, no longer a pivotal support. $18,550. Okay, let me tidy up everything. Okay, so right now we will have a tightened key short-term pivotal support over here as it continues to trade within a bullish ascending channel for the German 30 since the low of 6th of August. So right now still maintaining that short-term intraday bullish bias on the German 30 index. A breakout above the upper limit of yesterday's short-term resistance zone that we highlighted, which is 19,025 over here, potentially sees the next Fibo extension cluster level over here, 2.618 at one time at this 19,170 level next, okay, which is very close to the upper limit of this minor ascending channel as well. 170. Okay, so now as long as the price managed to maintain above 18,730, the bullish bias intact, but however it starts to come down and break down below 18,730, then we will actually negate this bullish bias to kickstart a much more minor corrective decline to retrace certain portion of this ongoing minor uptrend scenario from the low of 5th of August to expose the next near-term support level at 18,550 and potentially even much lower at 18,350, which is also confluence with the 50-day moving average, I think, as a similar support area as well. So that's for the German 30. Now, moving on will be the major US stock indices, the US Wall Street 30, the one of them, which is the Dow Jones Industrial Average, that has been outperforming the Nasdaq 100 and the S&P 500 due to the assistance of the bullish bull steepening of the US Treasury yield curve. So yesterday it managed to hit right at our resistance level 41,535 before shaping that pullback in the middle part of the US session yesterday. Okay, so with that, we will have a tightened key short-term pivotal support level for today, very close to yesterday's low at the start of the US session, 41,060. So as long as 41,060 short-term pivotal support holds, we will still maintain that short-term intraday bullish bias on the US Wall Street 30 above 41,535 exposes a new resistance level, which is another fresh all-time high at 41,800, potentially above it at 42,130, which is a 0.618 Fibo extension. Only hourly close below 41,060 will negate today's bullish bias to retest last we call it Wednesday US session low at 40,870, and a breakdown below it sees 40,610 next on the US Wall Street 30. So now with that, let us now shift our attention to the Nasdaq 100. So for the Nasdaq 100, yesterday we do highlight, despite Nvidia weak result, because it's holding on a key short-term support level, which is the 20-day moving average, and we do expect a bounce, and this bounce in dictate shape to retest around the 50-day moving average, hitting around the upper limit at 19,630 before shaping that pullback. So still no change, still using for sure 19,117 as my short-term pivotal support level for the Nasdaq 100, given that it can't break above 19,630. Still maintain that short-term intraday bullish bias above 19,630 exposes last Thursday minus swing high area at 19,900 next. All right, so that sum up the intraday technical outlook on the major cross asset classes. Now let us turn our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD continues to be in a bullish dynamic, but still can't break above the current all-time high area at 2,532. So what we could see over here is that the first support level will be at 2,500, but that will be a bit tight. So still using that 20-day moving average at 2,473, and also this purple line here, which is the former range resistance, now turns into a pullback support, also confluencing at 2,473. So as long as this minor pullback didn't surpass below 2,473, we will still maintain that short-term intraday bullish bias on gold XAU/USD, but it got to have a clearance above 2,532 to increase the odds of a start of a bullish impulsive up move to expose the next near-term resistance zone at 2,588/2,595. But however, if we start to have an hourly close below 2,473, then this intraday bullish bias will be invalidated to kickstart a kind of another round of minor corrective decline back to retest the rising 50-day moving average. They're also conversing with the next near-term support zone at 2,435/2,415 next. Okay, now with that, let us now focus our attention to the next commodity, which is crude oil, WTI crude. Okay, let me open up the chart. WTI crude over here. Okay, this WTI crude. So still recall WTI crude, yesterday we flipped back to a bullish bias because there's a bullish oversold condition that was printed, and price action continues to indeed shape a higher high and manage to reintegrate back above this so-called 20-day moving average. All right, over here. So with that, it really hit the first resistance, almost hit the second resistance yesterday before shaping that pullback and bounce off from the 7660 level. So let us adjust slightly lower over here, taking into account of the former minor swing high of 28th of August, now turns into pullback support, and also corresponding very closely to the 20-day moving average, now acting as a intermediate support level as well. So this will be my tightened key short-term pivotal support for today, which is 7610 level. Okay, let's wait for, okay, let me delete this. Let me open up a new one. Okay, let's wait for a while. Hopefully I can import the text. Okay, why I can't import the text? Okay, give it a minute now. Okay, good. Okay, 7610. Okay, put this in green. So this will be no longer a pivot. Okay, hopefully I can delete. Okay, let me say it verbally. It seems to me that it's hanging right now. Okay, so this pivot that we have yesterday will be tightened to 76.10, which correspond to the former minor swing high of 20th August, and now also I think it's at its intermediate support level, which is the 20-day moving average. So as long as 76.10 tighten short-term pivotal support holds, we will still maintain this ongoing intraday bullish bias on the West Texas oil. Is going to bounce back up towards the upper limit of this symmetrical triangle range over here. This is the upper limit of the range, linking the highs over here. So next resistance level to watch will be at 78.40. A breakout above it exposes the next near-term resistance zone of 79.50 slash 80.30 next. All right, but however, if price action starts to break down below 76.10, then potentially this will negate today's intraday bullish bias to revisit the 74.60 slash 74 near-term support zone thereafter, okay, which is not the pivot right now. Okay, the pattern pivot will be at 76.10. All right, so with that, that sum up the intraday technical outlook on the major cross asset classes. So before we go, let us have a quick look at the economic calendar. So like I mentioned earlier, today's data, key data will be the US PCE inflation. So what other data that we have during the European session that we should be taking note of will be the inflation rate out from another anchor European zone, Eurozone economy will be France, out at 2:45 p.m. Singapore time for the month of August. Is a flash rate. Then thereafter we have at 5 p.m. is the unified one. That means a unified taking into account of the entire economy in Eurozone. So the unified one will be up at 5 p.m. The Eurozone unified inflation rate will be out at 5 p.m. Singapore time, flash figure for the month of August. So market is expecting another low ball figure of 2.2%, down 4 basis points from 2.6% that was printed in July. And what we have over here will be the all important core PCE inflation data. So the year-on-year one market is today market is expecting a slight uptick of 2.7%. So if we start to decrease below market expectation, let's say at 2.5 to 2.4%, that potentially could actually increase the odds of the start of the interest rate cut cycle in September by the US Federal Reserve. So thereafter will be a rather quiet session. And what's interesting over here is that on Saturday morning, 9:30 a.m. Singapore time, China will release its key economic indicator, which is the MBS official manufacturing PMI, and as well as the non-manufacturing PMI for the month of August. So this potential movement or data release, if it comes down weaker than expected, it could impact the Hang Seng Index early Asia session on next Monday. All right. So with that, that sum up today's intraday, today's daily dose of market insights. I'm Kelvin Wong here, signing off. Wishing you all a restful weekend and do enjoy your weekend. And we shall speak again on next Monday. Thank you.